And so we're going to ask a pretty elementary question here, which is, is the medium of exchange role of money relevant for monetary economics? Maybe not so much in this room, but there's actually a consensus out there, and it's that sort of like a current wisdom that monetary economics can and perhaps should be done without M. What I mean by that is, without regard for money demand or the path of monetary aggregates. The way that's usually phrased a bit more carefully is that, maybe in places like Mexico, Argentina, Thailand, India, money M matters, but certainly not in developed economies, places where it's kind of like liquidity saving mechanisms have developed enough that you can support trillions of dollars of transactions with very small M. So that's a consensus, but when you look around, it's sort of grounded on two very specific results. The first is the fact that this is a paper by Mike Woodford. He gave his plenary at the Mexico City in 1996. A lot of you were there, I remember you. It was my first conference. And so he basically showed that he took a Lucas and Stokey cash credit economy, assumed in the background some kind of like fiscal monetary regime, which is important for the result. And then he showed that if there's a parameter where you take the proportion of cash goods to zero, then the equilibrium allocation and prices converge to somewhere. And he shows that that point where you get the limit of that procedure is actually pretty well approximated by an economy without monetary frictions and no cash. What he technically means by that is no monetary frictions. He means cash in advance constraint never binds, so no cash goods. And cashless, he literally means there's money in the background held as a redundant asset. It does nothing in terms of transactions. Okay, and that's kind of like sort of like the missing link of old Woodford and new Woodford, and then the book comes after, and that's a new way to do monetary economics. The second thing that's more like a theoretical result. The second is more like a quantitative one. If you look at the Jordi Galli textbook, for example, chapter 2. Before he throws money out, he gives it a chance. And the best chance he can give it at that point in time is put it in money in the utility function framework, non-separable. What else could you ask for, right? So, and then what he does, he says, basically, you can shock the nominal rate, the opportunity cost of holding cash. If it's complementary with consumption, it's going to distort, consumption of output and output. And then he basically says that, as long as one of your calibration targets is a realistic inverse velocity, so real balance over GDP that is as small as it is in the US, then that direct channel is very small. It's peanuts, you can throw it out. And Mike Woodford has a similar argument in his textbook. So that's kind of like a quantitative validation of the first argument. So I want to point out is that both are about 20 years old, and they rely on this reduced form sort of models, either cash in advance or a cooked up cash in advance version that ends up looking just like money in the utility function. So what we're going to do here is we're going to sort of revisit those two results, see how robust they are, and we're going to develop a model that micro foundations are tricky. You can always keep digging. So we're going to be as explicit as we know how to be today about the roles of money and credit in exchange. The second thing is we want the model to be very flexible in terms of velocity, because our results are going to be how monetary policy affects outcomes when velocity is very high. So we need that. And then the key ingredient for the results is going to be that we're going to allow for the fact that financial intermediaries have some market power. Okay? And that's going to be critical for our results. A special case of this would be perfect competition. But and then what we'll do is, the whole idea is going to be characterize price and allocations in this economy, then take a limit of some parameter that's going to mean that the equilibrium velocity goes on to infinity, and then check out to see whether the medium of exchange channel of money really disappears, like that seems to be believed. So our main finding right away is that these medium of exchange considerations actually turn out to be resilient and significant. What I mean by resilient is that everything I say from now on is conditional on some degree of financial frictions, which we'll talk about more later. But basically, as long as these financial intermediaries have some degree of market power, then we find that if you take the cash and credit economy and then take the limit of this parameter as it becomes a pure credit economy, then you get a bunch of price and allocations, follow where they go. Well, the limit point is not the same that you would have gotten by taking that limit in an economy where there's no money at all. Okay? There's a gap there. you can sort of think of it as a discontinuity, if you like. Again, it's not that Woodford made a math error in the SCD. No, I mean, we recover his results if there's perfect competition in financial markets, okay? And then, I said they were resilient because they still stand in the limit and they're significant. So we have a measure of, quantitatively how significant they are. I hope to be able to get there. But the bottom line is that, when I look at the impact of monetary policy on something that we have a pretty good handle on, which is how much they affect real equity prices, and we're going to use that as our metric. So we're going to calibrate the model so that, in the current conditions, we get the semi-elasticity of equity price responses to money shocks that is as in the data, and then we'll look at the sort of cashless limit and see how much the semi-elasticity responds, okay? And we'll see that we lose some of the response, but even in the limit, you still get a significant amount. So the bottom line is going to be that, at least generically, it does not seem that cashless economies are good approximations to monetary economies, even very high velocity economies. Okay, so what's the intuition? So let me backtrack a second. So if you think about it, when you tell it to a non-economist that, Feds all over the world are doing monetary policy without money at all, it seems crazy stuff. But that's a little unfair. When you think like an economist, the logic is, real balances over GDP are very small. So if you were to distort that directly, how big an effect can you have on aggregates? That's kind of the general idea. So you see this back of the envelope calculations, like, I don't know, M1 over GDP, is about like 1/10 a year. And so then, you think, okay, what's the opportunity cost of that? It's like 1%. So back on the envelope, it's like 1/10 of 1%. That's your cost. It's not a big deal. Let's focus on something else. That's kind of so Randy and I have a paper that, we basically say, in terms of looking at welfare cost of inflation, that's misleading. Of course, curvature matters a lot and a bunch of other things. And so we find sizable numbers even for, even if, if velocity is as in the data, because we match it in our calibration. So this paper is saying it's kind of a complement that they're saying, not only for normative is misleading, even for positive is misleading. It's not that you don't see it on aggregates just because real balances are small. Okay, so what's the intuition? The intuition is that when you have some market power on the financial intermediaries, then money affects terms of trade, prices, in transactions that are carried out with money, but also in transactions that are not carried out with money, okay? And the basic idea is that it's the option to engage in monetary trade is going to be acting as a discipline device on the market power of financial intermediaries. So the point is, there's going to be an off-equilibrium, there's a volume of trade that you could trade with money. It's a threat that you could perform this trade that's going to be effectively acting as a discipline device that's available for everyone. It's available for people who don't hold cash or want to hold cash, okay? So the point is, even if you have a very small footprint on that volume of transactions, it's going to affect everybody through this outside option channel. That's what's the way it's working. So that sounds maybe a little bit esoteric. So the point of this slide is mostly arguing that it's as old as the hills and it's everywhere when you start looking. So there's a bunch of papers here. The fact that money can give people sort of some, it gives you strategic power in negotiations. That's bread and butter for search and money. So Neil and Tao Zhou have a paper on that. Randy has a recent paper like that in the AER. So ours is slightly different, but this general idea is out there. The main point are this trade literature. So Virgilio was the first guy who told me, you should look at this trade literature. So I started with Tom Holmes' paper, and then went from there back to Marcusen, and then somebody told me, no, that's Bhagwati. So the whole point is this. These are papers that show that even though the volume of international trade can be very small, when you have market power in domestic markets, the threat of international trade can have a big impact on prices, welfare, and allocations. That's all. So Marcusen is the best example. You have a two-country model. They're identical technologies, a monopolist in each, and let's say that there's trade is forbidden. So you get monopoly outcome in both. And then suppose that you open up trade. Now there's free trade. You will see no flow of trade because they're identical technologies. But all of a sudden they become duopolists, and now the allocation improves. So if you couldn't read from the fact that the volume of trade is small, that there's no impact on welfare. So my late colleague Baumol has the idea of contestable markets. that's related to that. Bhagwati, this is the paper that says that with perfect competition, quotas and tariffs are equivalents. You can replicate the allocation with one or the other. Within perfect competition, the equivalence breaks down. And that's also related to this. When you impose a quota, the local, say it's a monopolist, the local guy acts as a monopolist on residual demand after you take off the quota. When you put a tariff, he's still disciplined by the fact that if you increase the price above the tariff, people go by outside. So this is everywhere. We're just saying it might be relevant for monetary economics as well. So I want to show you the model pretty quickly. This is a preview. Then I'll show you the environment, and then I'll go straight to an Euler equation. That's the plan. So I don't expect you to get the whole model from this. It's just to. So there's going to be two types of agents, infinite horizon. These people we call the bond brokers and the investors. They're going to be interacting over time, sometimes in these centralized markets. They're going to be consuming, supplying labor, and making a portfolio allocation that involves the two assets in this economy, which is an equity share. Think of it as a claim on a Lucas tree and fiat money. And then they walk into the next period with a given portfolio. The key actors here are the investors. So the investors they're going to be getting some kind of idiosyncratic valuation shock for the stock. With some probability you like it a lot, you'd like to buy more than you got last night. Some probability you get a bad valuation, you would like to get rid of it. Now the issue is, how are you able to get rid of it? There's two trading situations you can find yourselves in. With some probability alpha, you are able to trade the equity in a market where you can trade equity and money. Okay? So you'd be like a cash in advance guy, if you like. With complementary probability, you're a more sophisticated investor who can simultaneously trade in the equity and money market and in the bond and money market. So if you're here, you could issue bonds. Okay? So you can lever up to buy more equity if you like, or if you're a seller of equity, you could sell the equity and then lend in that bond market. Okay? So the point is, in an economy with no money, these guys will still be able to trade because they can simultaneously issue a claim. It's going to be a claim on goods payable here. You can simultaneously short the bond and buy equity. So even without money, there's going to be some trade here. So the exercise is going to be characterize the prices and allocations in the equilibrium that looks like this, with some probability you might end up like this, some probability you might end up like that, and take the fraction of agents who must trade through cash to 0, and then see where the price and allocations go, and then compare that to the way they would look in the economy with no money. That's kind of the whole point. Okay, so the model I ran pretty quickly. It's going to be, like I said, infinite horizon, two types of agents, investors and brokers. Oh, sorry. So one thing I meant to say is the market power is going to come in here. So when this investor, it's like he has a broker on the line, and he can trade directly in the equity market. So he has two lines, and he's simultaneously trading. This trade is the one that's going to have market power on the broker. Okay? So you can think of it as a little bargaining game, for example. Okay, so there's going to be two types of goods. This dividend good, which is the motive for retrading the equity, and the general good, that's the good that's traded in the second stage. Preferences, everybody has linear preferences, so brokers are not very interesting. That's consumption of the general good in the second stage. That's labor supply in the second stage. That's the same for investors, except investors also value the dividend. And the epsilon is this idiosyncratic valuation shock that makes them want to buy or more or less equity at the beginning of the period. That's IID over time, but yeah. Okay, so in terms of endowments and technology, in the first period, there's this fixed proportion or number of trees, AS. Each tree gives a dividend. In the second subperiod, everybody can supply labor to produce a general good. Like I said, there's three financial assets, the money. It's going to be a constant growth rate of the money supply. There's going to be our policy parameter. Later, we'll map it into a nominal rate. That's just not that relevant. There's an equity share outstanding for each tree. And there's a bond. That's the bond that gets issued in the first period, right? So the bond is basically a sure claim to 1 unit of general good. So it's an intra-period bond. Okay? At the beginning of the period, you issue the bond. That's a commitment to pay back a general good. Well, I said commitment. There's actually no commitment. If you default, then the bondholder can appropriate a fraction lambda of your equity shares. That's like a Kentucky more credit constraint. Yeah. Like I said, for example, lambda 1 would be allowing people infinite leverage. Everything goes through. But we think this is kind of maybe an easier way to explain it. This is the same picture I showed you earlier. There's two contemporaneous markets, right? The bond market, where you can trade bonds and money. The equity market, we can trade equity and money. Brokers always have access to this picture again, right? So you have these two markets are running simultaneously every first half period. Brokers always have access to the bond market. Investors have access to the equity market with probability alpha. With probability 1 minus alpha, they have access to both simultaneously. Okay, that's what I was showing you here. So alpha 1 minus alpha. Sometimes I'll call it alpha C for credit, because it doesn't fit. And then the market power will model it as Nash bargaining between the investor and the broker. And theta is going to be the bargaining power of the investor. So if theta is equal to 1, they'll be perfectly competitive. That's the case where we recover the Woodford continuity in the cashless limit. Okay, yeah, so let me show you how this works. So at the end of the day, I'm going to have to solve for two trading portfolios. Say again? If alpha is equal to 0 as well? No, that's the biggest difference from Woodford. It's actually like that. Yeah, the further away you get, yes. So basically, okay, so that's the maximum market power the broker can have. That gives you the biggest discontinuity. So there's two trading situations, right? For an investor that's the cash in advance investor who wants to reallocate the asset portfolio, the equity portfolio and money, and the investor who has simultaneous access to both markets. So I'll show you two bargaining outcomes in those cases, okay? So instead of showing you the equations, this is how it works. Remember, epsilon, that's the space of your valuation shock. So on the top, you have the cash in advance investor. So this is the investor without access credit. So this person, the trading strategy in that first sub-period is, if you get an epsilon valuation shock above some threshold, then what you do is, you have linear preferences. You go all into equity and spend all your cash, okay? If you're below, then you're a natural equity seller. You sell all your equity and all you can get. The only way you can settle here is by holding the cash. Okay, you're a cash in advance guy. If you're an investor with access to credit, that's probability alpha, that's probability 1 minus alpha. If you have access to credit, you have another threshold that characterizes your optimal decision. And then if your private valuation is above that threshold, again, you're a natural buyer of the equity. You want to long the equity as much as possible, so you do that. And the way you buy as much as possible is you spend all your cash and you short the bond as much as you can. You hit the Kentucky Moore borrowing limit. If you happen to have an epsilon below that, you sell all your equity, and then what you do is, what you do with the proceeds, you basically spend any proceeds from selling the equity and any cash you walked in with to long the bond, because you earn interest on the bond. Okay? So those are the trading decisions, all right? Now, those are in a monetary economy. So the way the non-monetary economy looks is it's pretty similar, except there's no cash in the picture. So non-monetary economy is, if you're a person without access to the credit intermediation, then basically, yeah, you're in autarky. You're just in touch with, you can't short or long the bond, so you can trade. If you're an agent with access to the credit market, that's probability alpha, that's 1 minus alpha, then you can still trade. If you're above a certain threshold, which is endogenous again, you buy equity shorting the bond. Otherwise, you sell the equity and you long the bond. Okay? So, yeah, you have it?
So just kind of
yeah.
So I thought you wanted to just take the limit from the monetary economy.
Well.
Oh, you want to show that it's continuous?
Well, I mean, I'm going to have, there's a world with money. There's a world without. I'm going to take the same parameter in both worlds and see where they go and then compare both limit points.
So you want to show that it's continuous?
Yes, I want to show the difference.
For your point, you could just do it without this one and still it would work. The whole point is that still
I mean, I will still show you the effects in that limit. I could do that.
the limit of the
Yeah.
You want to show that there's continuity in the limit.
Yes.
But you don't need to show the other one. You want to show that.
No, you do. He's probably better doing all.
I'll show you. I'll show you right now. Yeah, I saw the 10. Okay, so let me just show you. This is the trading situation of the investor. This is a key thing. The trading situation of the investor who is trading with the broker. Okay, so this is the Nash bargaining. That's a gain from trade to the investor. It's this. They're jointly choosing a portfolio of, for the investor. So I call the broker, and the way it works is the broker says, you know what? have my platform, do the trade you like, and then I charge you a fee K. That's basically the way it works. So the A bar is the money holdings, stock holdings, and bond holdings that the investor chooses for himself, and the K that he bargains to give the broker. Now, so this is the budget constraint of the investor. That's the Kentucky-Moore constraint. This is the fact that it has to be voluntary for the investor to do it. And this is the gain from trade to the investor. Okay? So one way to think of this is, suppose that the investor is making a take-it-or-leave-it offer. So that would be the case where theta is 1. Then the investor maximizes his continuation payoff. Okay? That's his utility from the dividend, and that's his continuation payoff of entering the next stage. Okay? If it's actually the broker making the take-it-or-leave-it offer, it'll be like theta 0, for example, then it's going to push the investor to indifference. That's his outside option. That's a red term. Now, what's a hat portfolio? The hat portfolio is the portfolio that the investor would choose if he had only access to the money market. So this guy has access to both. So the most the broker can do to you is take the gain that's apportioned to getting access to the credit market. But he cannot take away from you the access to the cash transaction. That's a critical thing. So if you did this for the economy with no money, then the outside option here would be autarky. Okay, so here's the Euler equation. So on the left, that's the real value of an equity share. The first term is a lot of notation that I haven't introduced. It's just placeholders for me to say the words. So don't. So the first one would be like, this is an economy with like retrading. So that would be like a Lucas tree economy. The value of the equity today would be, the expected dividend and then the resale value. But here, other things can happen, and you can retrade on that. So for example, the first thing that can happen is you might get a valuation shock that is above a certain threshold. That's the case where you'd like to buy more. Then at the margin, the equity that you walked into the period with has value as collateral. So there you see something that looks like lambda over 1 minus lambda. That's the leverage ratio that typically shows up. And that's your gain from buying an additional unit of asset. Okay? Now, on the margin, the equity share also has value. So this will be like a Kentucky-Moore collateral term. This one is like a Harrison-Krebs resale value term. So if you happen to be a low valuation tomorrow, then you can resell it at the market price, and that's the opportunity cost of reselling. That's your private cum dividend valuation. And that increases the ex-ante value of the asset, right? If you're low valuation type, you're not stuck with the asset. You can flip it to a high valuation guy and get some of the gain from trade. Okay, so this is the Harrison-Krebs resale value. Notice these two, of course, you can lever up only if you have access to the credit market. That's a 1 minus alpha parameter. And you get the sum of the market power. Similarly, you get the gains from reselling, okay, when you have access to the credit. Now, these terms are the ones that would show up even in the non-monetary economy, okay? You can only get gains from additional holdings of the asset when you can lever up or when you can use the Harrison-Krebs resale option when you have access to credit. That's why there's alpha C. In the monetary economy, there's two more terms. First of all, and there are two Harrison-Krebs terms, these two. I mean, that one and that one, okay? One Harrison-Krebs term is if you are a guy without access to credit and you want to sell, well, you can't settle the transaction if there's no cash. So this term is saying in a monetary economy, you can execute that trade and get some of the Harrison-Krebs gain. The second one is kind of the complement of that one. See, this is the Harrison-Krebs term when you have access to credit. Now, you only get it if you get, suppose that it's a coin flip. Probability theta, investor makes a leave offer, 1 minus theta, the dealer makes it. You only get this gain with probability theta when you win the coin flip. What if you lose the coin flip? In the economy with no money, you're pushed against autarky, so there's no gain. In the economy with money, there's this additional thing, which is if you contact the broker and you lose the coin flip, you don't get that exact gain, you get that gain. But what is that gain? This is the Harrison-Krebs gain that you would get if you're a cash-only guy. You see what I'm saying? The cash-only guy gets this gain from reselling. The guy with access to credit who loses the coin flip, has no market power, gets the same gain from trade as the cash-only guy. He's being pushed against his indifference, which in this case is mimicking the cash guy. Okay? So the whole point is, when I start taking limits later, this term will go away when I take alpha to 0. Remember, alpha C is 1 minus alpha. So this term will go away. This term, which is the outside option term, it's never going away. And that's going to be showing up in the Euler equations throughout, in the pricing equations throughout. Okay, so this is a non-monetary economy. For now, I'm going to write the monetary prices as non-monetary plus. That's why. And then I'll show you the plus thing is positive. Yeah. Yeah. So then this is a non-monetary equilibrium price. It's the expected dividend, and then there is the Kentucky-Moore resale value option term and the Harrison-Krebs, which only happens when you have access to credit, because in the non-monetary world, you're not working without access to credit. And then the way you solve it is very simple. You have this threshold decision for the investor when to buy equity, when not, and it's just this, that's a CDF of the valuation shock, and lambda is a Kentucky-Moore collateral parameter. So you solve this equation, plug it in, you get the price. So that's not a big deal. So the way the monetary equilibrium looks is basically like this. Yeah, so let me skip that. So I'm going to focus on a case. So depending on parameters, you can get money dominated in rate of return or not. So I'm going to focus from now on parameters where money, money is dominated in rate of return, meaning the bond market could clear at zero interest or positive interest. I'm going to look for parameters where it clears at positive interest. That's more interesting because in the limit, money will want to disappear. Okay, so this is the asset price, the real equity price in the monetary world. It's the same as the non-monetary world plus the two terms that you remember from the Euler equation. The asset had value at the margin because of the Harrison-Krebs resale value, this bit, the resale value, which you can execute when there's money around, even when you don't contact the broker, and you can secure that gain when you contact a broker and you have no market power, because that's the worst position the broker can leave you in. He can force you, he can lock you out to the credit market, he can't lock you out to the cash market. You can always do that on your own. Okay? Yeah, all I'm saying is now there's two thresholds. The epsilon double star for the investor with access to credit, the epsilon single star access to credit. It's pretty simple to solve for them, so I'm not going to dwell on that. So cashless limit, like I said, remember, what I'm going to do is I'm going to take alpha to 0, the proportion of agents who must trade with cash to 0. And so it's an economy where everybody can potentially just do this, like what Excel calls this gyro system, like just a massive clearing of IOUs. Okay, so this is the limit when you take alpha to 0 of the asset price in the non-monetary world. Okay? Yeah, it's pretty simple. It's the one I showed you before, except the alpha C, which is 1 minus alpha, just became a 1. There's no alphas anywhere else. So that limit's super simple. Yes, sorry.
Scaling anything else when you're taking that limit? Are you changing quantities of money or?
No, in the background, I'm keeping money growth constant. So it's like a money growth. It could be, it could be 0 money growth, whatever you want. So that's the only. Say again?
False intuition is that somehow the price level, the nominal price level would be.
Yeah, things are happening. Yeah, absolutely. Oh, yes. I mean, when I do that.
The PT plus 1 disappear when you. Here it disappears. It was before.
Yeah,
you must
but
solve for it.
the epsilon stars depend on real balance and stuff. Yes. I mean, look, I'm only showing you the asset price. I have equations for the real balances and everything else, which I'm not showing here, but in a longer one I would. So the point is this. I just wanted to say, I'm going to take alpha to 0. I take alpha to 0, okay? And then here's what you get. So, here, that's Z is a real balance, and that's velocity, okay? So that's like, real balances over GDP. So, I have another slide in the longer presentation where you see the expression for Z. The whole point is when I take alpha to 0, Z goes to 0. So the price level is shooting off to infinity, okay? So it looks cashless. Velocity is going to infinity because there's still some transactions through credit. Now, the asset price, and this is a part that maybe it surprised us. We thought we were wrong for months. So the asset price is converging to the limit of or the limit price in the non-monetary world. Now, that's what I would have expected. In any monetary model I've ever worked on, cash in advance, money utility function, I don't solve for the non-monetary equilibrium independently. I solve for the monetary equilibrium, then plug Z to 0, real balance to 0, and you get the allocation. I was doing this for a while, and I got nervous. I don't know, because there was credit going on. It gives you the wrong answer. Okay, so that's how we spotted this discontinuity in terms of the Z. So the point is, here you have an economy where the Z is 0, but the price is not the same as in the non-monetary world, which would have been the natural guess. It's that plus something. What is that? The Harrison-Krebs resale value option. There's an epsilon star, which you remember is a threshold, is the optimal trading decision of the cash-only guy. There's virtually none of these, virtually none in the cashless limit. 0. I don't believe that. You're right. You're right. We have a long-term relationship, you and I. Can I borrow a minute? No. Thank you. No, but I cannot. I have to leave. This slide will be my last one. I promise that. So let me explain. The bottom line is that term, that epsilon star, solves this mapping. That thing here is the inflation rate or the nominal rate. So the point is, you have an economy where real balances are 0, there's no money around, yet you touch the nominal rate and you affect the real equity prices. That's the whole thing.
Yeah, I'm going to discuss LEGO-Zhang. I'm not going to discuss this paper. I'll discuss the research program. I much prefer their second paper because instead of focusing on asset markets, it's a regular goods market. I mean, both are fine. It's nice to have options. But here you're seeing what looks like investors trading assets. I think it's simpler and fits better with the literature to see the one with households trading goods. It's not a big deal. And I'm really going to talk mostly about Minneapolis in this talk. Some good things and maybe some other things to say. So this paper is in the tradition of work in Minneapolis, both at the university and at the Fed, on monetary economics. This tradition, I think, is quite good. There's a level of rigor and creativity that's all too rare in macro. General equilibrium theory is used to the full power and beyond. Mechanism design theory is used. Search theory, bargaining theory, things that a lot of macroeconomists don't like or don't understand. Inspiration for this work comes from, I mentioned 3 names, Wallace, Sargent, and Townsend. And let's not forget Kiyotaki and Coach Lakota, who were at the U. Let's not forget Leo Hurwitz, who inspired me, and I think I use Hurwitz's ideas to inspire my students. And perhaps most importantly, in this Minnesota monetary tradition, there's Lagos. More on this below. So the Hurwitz-Wallace-Townsend approach is, I see it as follows. Institutions should arise endogenously. And these institutions would include monetary exchange, certain types of credit arrangements, financial intermediation, et cetera. Now, I learned this from Prescott. For many, it depends what's a good idea, depends on what the question is. But for many questions, it's just bad economics to impose restrictions like missing markets, cash and advance constraints, nominal contracts, or otherwise incomplete contracts. And in particular, my spin is market structure, by which I mean trading arrangements, should be the outcome of our models and not inputs to our models. I'll give some examples. I don't know if these are that interesting, but if agents in a model want to use cash, we should let them. This is very similar to the LEGO-Zhang idea. And of course, the flip side is if they prefer not to use cash, it seems ridiculous to force them. It should be their choice. If they want index contracts, we can't preclude those contracts. The agents in the model, it's up to them what arrangements they enter into. Apropos banking, I'm not an expert on this, but if they prefer deposit contracts that prevent runs, Neil mentioned one in his talk, but there's simpler ones in many diamond DIVIGs, simple suspension clauses, and much of the literature disallows those kind of clauses in the deposit contract because they want to get runs. That's bad economics. You can go very wrong. The policy implications are very different, and they hinge critically on ad hoc ruling out of simple suspension clauses. So like these guys, Lagos and Zhang, I use search theory, but I don't think most of you know what I mean by that. I like it because it builds on the idea missing from GE, and DeBrew kind of talked about this a little bit. In the real world, but not in the general theory, agents trade with each other. And that's kind of what search theory is to me. And that's kind of, I think, necessary to ask the question, how do agents trade? Do they use barter, money, secured or unsecured credit? Do they trade through intermediaries? So it's not really about spatial separation, which you might think of as search. And it's not even about random matching. You can do it with directed matching. In fact, I don't think Neil usually uses the word search. He often refers to pairwise trading. And this pairwise trading is important because then you can start asking, and the issues pop off the page when you're writing these models. Now, how do we pay for stuff? That's not discussed in GE theory. You just slide along your budget line, picking your preferred point. How you pay for it is not really up for discussion, the way it is in models with pairwise trade. Cash and advance models, which are trivial perturbations of general equilibrium theory, are useless in this regard, in my opinion. Keyhole Levine credit models are better, much better, although some of us prefer the versions that aren't quite so Walrasian. Lagos Zhang's paper, if everything was Walrasian, none of these results would hold. It's important to have some kind of imperfect. I have something to say about banking here, but so I'm saying these issues are relevant for monetary models, credit models, banking models. I probably don't have time. I have some critique of Gertler Kiyotaki. Cristiano sorted me out on a better way to do it. If we have time, we'll talk about that at the end, but we probably won't. So monetary theory is hard because these exchange patterns are endogenous. That's what you're after. You're after getting as an equilibrium or sometimes a socially efficient, say a solution to a mechanism design problem, exchange patterns. So we can know who trades with whom, when, where, how do they pay, and how do they determine the terms of trade? Bargaining, price posting, auctions. You can stick Walrasian pricing in there, but I don't know. It's not so obvious it's a good idea. Equilibrium search theory, which I attribute to coming from Diamond, as opposed to prior decision theoretic search, like Mortenson's models of the labor market. Well, it's not the model of the labor market, it's the model of one worker. But equilibrium search theory, it's not because you have to search for a counterparty per se, it's that you trade with counterparties, so what Neil calls pairwise exchange. These models are hard because they're computationally intense. So look at Maliko's 2007 version of a search-based monetary economy without strong restrictions on, say, portfolios. You can't use Crucell-Smith because Crucell-Smith is about Walrasian models. Agents don't care about the distribution of liquidity or wealth per se, they only care about the prices because they're sliding along budget lines. And it turns out you can approximate the dependence of prices on the distribution quite well with a small number of parameters, like a small number of moments, like the mean often. Doesn't work in Maliko because you care about the distribution per se, because you're drawing counterparties from the distribution. So you need many more moments to accurately characterize that. And moreover, competitive price taking, as I alluded to earlier, is not so appealing when you're trading bilaterally. So, these things are hard and non-standard, and maybe that's why search-based monetary economics is sometimes disparaged, despised by some people in Minnesota. Now, I don't take it too personally because Treos, Lagos, and Menzio, they tried to hire all these guys, and they're kind of like my students. But sometimes I feel like, a radical religious parent, and they want to adopt my kids, but only to deprogram them. I mentioned Wallace again here. Wallace embraced the notion of pairwise trade. I was rereading his sequential service version of Diamond Dybvig. You can see he was, I hate to talk about him as though he were dead, but I see him as grasping for this notion of agents trading with each, He's grasping for this idea of agents trading with each other in real time, which is pretty hard to get in a Walrasian context. Or look at Towns and Wallace, where they have, they want to get circulating private debt, so agents follow these complicated deterministic itineraries of, I meet Lucas, then I meet Cristiano, then Cristiano meets Lagos. Those are complicated. With the early search models of money said, who do you meet? It's just a random draw. Just so easy. But serious monetary economics has traditionally been unpopular outside of Minnesota, too. Zariadis goes on and on about this, and so do Kiyotaki Board. You can read these for yourself if you like. The bottom line here is these models were totally not dismissed. I mean, they were highly regarded. They're ingenious and beautiful and logically coherent, and I think those are good things, but they were never used anywhere because they're so far from competitive markets. And then along comes Lagos and changes everything. He brings competitive markets back into this alternating centralized, decentralized market structure. My name sometimes gets associated with this device or technique, but it's his idea. I give him full credit. I just used it, or we used it together. This alternating structure does several things, and he made huge use of it today. It hugely simplifies the analysis. All the action takes place in what he called the decentralized market, whatever he called it, the bond, equity, money markets. But having the centralized market means you don't got to track the distribution over time of liquidity or assets or portfolios across agents. So you don't need to go to hard computer programs like Maliko. You can do a lot of stuff by hand, like take limits. And I kind of like this. I mean, you know, I was trained under Hurwitz and others in general equilibrium theory, but I also studied at the feet of Mortensen and Burdett, and at least at the books of Pissarides and Diamond. So this marries the two. You can shut down the decentralized market and you're back to Kittle and Prescott, although the version we saw today didn't have capital, but it's not hard to get capital in. Some people don't like this. Tim doesn't like anything I do. But when I showed him the version of Lagos Wright with capital, he says, why should I be interested in the bastard child of Neil Wallace and Ed Prescott? But moreover, relative to Kittle and Prescott, there's new elements. There's free entry. There's meeting technologies that tell you how market tightness affects who trades with whom. There are bargaining, and not only bargaining, there are various other devices, including some fancy mechanisms to determine the terms of trade. Some people quibble with functional forms. This is not that important, but you know, Lagos used a linear utility. Well, you need quasi-linear utility. Some people don't like that. And aside about the interactions between different people in Minnesota, this quasi-linear specification that makes the Lagos model work emerges naturally in Rogers and Hanson economies. Agents act as if they're quasi-linear. But anyway, Lagos's idea provides us a benchmark for monetary economics, just like neoclassical growth theory is a benchmark in mainstream macro. Much of mainstream macro is interesting because of incomplete market, heterogeneous agent issues, but it's nice to have the growth model, the standard growth model with complete markets and a representative agent, because you can prove existence, uniqueness, think about dynamics, do a lot of things analytically, and these things are important in monetary economics especially. Of course, a complete market heterogeneous agent model in monetary economics doesn't, or sorry, representative agent model doesn't go anywhere in macro. We need a different benchmark. Now, let's move on. So why deal, I only have 4 minutes I think I have. I started late. Why study micro-founded models? Well, Neil says to check consistency or correctness of claims and to derive new insights. This paper considers the first. The claim, because money is a small part of life in the good old USA, it's okay to ignore it when analyzing Fed policy. I have two interesting asides. I hope somebody at some point asks me what the Bob Hall critique is, although maybe it's better not to say it in public. It's a critique of Bob Hall, not by him. Woodford not only got rid of cash, he got rid of banks, asset markets, everything else. And he did worry about that when the crisis hit. He knew there was problems. Anyway, Lagos Zhang proved the claim is false. It's not some bullshit. It's a mathematical proof. It's a discontinuity. The limit of monetary economies as the use of money begins to vanish is not the same as the non-monetary economy people have been studying. They show this in several models. You saw one today, but there's other models. This discontinuity might not be so surprising. So here's another one. In many models of money and models of credit, infinite horizon economies are not at all well approximated by T-horizon economies for any T that's finite. Probably more apropos is examples like in bargaining theory, agents don't bargain. The first offer is accepted. But the threat to reject it disciplines the equilibrium offer. Or in credit models, agents don't default. But the threat to default, so same thing in Lagos Zhang. The threat of using money helps discipline the equilibrium outcome. But whether or not it's surprising, it's profound and important, especially for people at the Fed whose job it is, there's the mandate to analyze and implement monetary policy. They ought to know this stuff. I have a bunch of related results in the literature, but I don't have time to talk about them. I wish I did. I'll skip the good joke there. The point of my examples is to show things that are kind of similar. It's not to minimize their result, but to emphasize that the framework they use has many interesting implications. And you could generalize it in so many ways. I just hate when people say it's about fiat currency. It's not. You can add banks, multiple assets. I have this wonderful quote from Frank Hahn that I wish you guys were able to see. But I'll finish with this. I got to show the Frank Hahn. This is good entertainment. This is seriously. So his discussion on methods and models in monetary economics starts with the idea that the natural place to begin is taking the idea seriously that money helps in exchange. And then he goes on to blabber about a bunch of stuff, and he ends with this. This is just poetry. I should like to end on a defensive note. To many who call themselves monetary economists, the problems with which I have been discussing must seem excessively abstract and uninteresting. Will this preoccupation with foundations help one iota in formulating monetary policy? Are not IS and LM sufficient unto the day? I don't know, I'm looking at all of you. It may well be the approaches here utilized will not approve our advice to the Bank of England. I'm rather convinced, however, it'll make a fundamental difference to the way we view decentralized economies, and that's true of what Hahn was talking about and what Lagos was talking about. But I'm less defensive than Hahn these days. I just got back from Bank of Canada. The biggest issue at the Bank of Canada is should they be issuing central bank digital currency? That institutional design question, it makes open market operations seem like a joke. Who cares what's the overnight nominal interest rate in the interbank market? We may care more about whether we have multiple currencies, digital versus paper, private versus public. That's a hugely, and I think the only models that speak to these kind of big institutional questions are the ones like Lagos and Zhang. So in conclusion, Lagos and Zhang are carrying on the Minnesota tradition of developing new approaches to monetary economics. As the Minnesota tradition develops new approaches to business cycle theory, econometrics, etc., they could be purely theoretical. When the people were an overlapping generations model, it didn't seem so obvious what the policy implications were. But they ultimately may have big policy implications. And how does this tradition flourish so well in Minneapolis? It's in a large part due to the cooperative arrangement between the U and the Fed. So I applaud this paper as continuing a strong Minnesota tradition.